The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everyone. That's Sean Campbell playing his bishop music.
Good morning, everyone.
We're glad that you're here. I'm Rob Booker. I'm joined by the Bishop, Sean Campbell, and this is the Arizona Rules webinar number 4, Range Trading in the Tucson Phase. Last night we presented this webinar in high definition, had a great time, spoke about the Jerome trade, the Tucson phase, had some, I would say, real breakthroughs with respect to how we think about range trading and why we do it the way that we do. Today we'll spend about 60 minutes in our webinar. If you have questions, we'll go longer than that, of course, but it shouldn't take us as long today to present the same material that we presented yesterday. The entire webinar is ready for you and available on the website right now. You can actually go to the Arizona Rules of Trading forum. You can click on Webinar Archive, and the webinar from last night, from the 22nd, is already available. The primary methodology of trading was the Jerome trade. I've actually got that video up and ready for you to watch already. Inside of the archive, you can watch how we trade the Jerome trade. Today we're going to speak about it again, so you're going to get 2 cracks at this most interesting and innovative technique for trading the range, and we're glad that you're here. But not only that, we have major announcements ready for you right now. The first is, of course, that the forum is popping. There are new indicators posted in the forum, new methods of looking at things posted in the forum. There are questions that are popping up in the forum, and we encourage your participation. Remember, the best way to use the forum is to depend on your own ability to answer each other's questions, and then when that fails, Sean and I will jump in there and join with you. You can, once again, find the webinar from last night archived and ready to go already inside of the forum. And you can find the segment dealing with the specific trade methodology, the primary one from last night, already posted there as well. Within about 12 hours from the webinar today that we're doing right now, you should see the recording posted inside the forum under May 23rd, Range Trading Repeat. All right, there are more announcements than just that. If you are a user of an Android mobile device, such as a Galaxy Note, a Samsung Galaxy S2, or any of the recent Android mobile devices for your phone, the Motorola Droid or other devices, the app is ready and downloadable for you only. I have a secret search that you can do on the Android store, and we've had 13 of our members download and begin testing the app. If you go to the Google Play Store on your phone or on the web and type in TF as in Frank, L 365, you'll pull up the Trade app. If you search for the Trade app, you will not find the app in the store. I've sort of hidden it back here so it's not available to the general public just yet. It's free for you, and it's downloadable and installable on your phone. And here's what it does. We have a news feature on the app which will be updated about once a day to start, and then more frequently after that. Right now you can see a welcome to the app on that welcome screen. The most important part of the app is that it produces frequently, 20 or more times per day, a trade on the currency market, and it posts that trade automatically with price, entry, stop, and target information right on the chart in front of you. You can click the chart and open it up to get a better look at the trade. But these are all Diamondback plus divergence trades. So the app is ready, and it's in the Android store. Apple has informed me that they are in the process of verifying my identity, and the app approval process could take as much as 3 weeks for the app to show up inside the App Store. It's just the way that they function. It's nothing that I can do or change. So if you use an Apple device, I have developed this for the iPad and for the iPhone, and it is coming, and it has been uploaded, and it is on the way into the App Store. This is available just for you, for being a part of the course. I'm really grateful that you're here. The app is designed to show you trades as they appear on the stock market and the currency market. Now, there's also a video channel inside that app also. That video channel is a link into my YouTube channel, which will play some of the videos from the Arizona Rules webinar series, as well as brief updates from time to time. On the next install and update of this app for both devices, the channel will change on the YouTube, and they will be short videos designed to bring you a tidbit or a trick or a trade. And then we'll also add in a link to the podcast. So this is something that I promised to bring you. We've had questions about it. You can ask questions during the webinar today about it. You can ask me questions on Twitter, and you can jump on the forum and ask me questions when you get to there as well. But that's the update. That's where the app is. That's how to find the app, and that's why you might want to use it. It's quite exciting. Got word that some people have just downloaded it. It's not yet downloadable for the iPhone. It's simply because Apple takes about 3 weeks to approve the app. It just simply takes longer, but it is done. The programming is complete. Everything is complete, and we're just waiting for them to approve the app for the App Store. And I submitted both of them at the same time, and Google is just much quicker about approving them than Apple is. Bishop, any other updates that we need to give on the course or anything else?
No, not off the top of my head.
Okay, great. Well, we're happy you're all here. We're going to jump right into the Jerome trade next, but I'm going to pause and stop the recording so we can separate the welcome that we just did from the actual teaching of the strategy. We're back for the Jerome Plus discussion in webinar number 4 of the Arizona Rules of Trading, Tucson Phase Range Trading. My favorite trade of all, actually, in all of the Arizona Rules is coming up right now. I know that sounds crazy, but it's true. This is my favorite trade of all of the trades inside of the new Arizona Rules. I love this trade. This is the Jerome Plus trade. We'll take everything we know about the Jerome trade and add a plus to it. In order to trade this, I want you to look at the Australian dollar, US dollar 5-minute chart, if you can, or 15-minute chart, or 1-hour chart. This is particularly a good strategy on the Australian dollar, US dollar. It works on every single financial instrument that you can find. But I have done extensive work on the Australian dollar, US dollar, so I'm most comfortable with that. However, if you want to trade Apple or the indexes or any other financial instrument, you are free to do so, and it will work just fine on those instruments as well. So any time frame chart, any financial instrument is perfectly fine. I want to also repeat again that although I just said that, I'm going to show examples right now to start with from the Australian dollar, US dollar 5-minute chart. We're going to change the MACD settings, whether you're using the MACD divergence indicator you can download from the forum, or you're using a traditional MACD indicator that you download. We're going to use the settings 30, 65, and 23. I'll write those on my chart so that you can see them in big, bold and beautiful letters. 30, 65, 23. 30, 65, 23. There you go. I can't do it. Gregorian chant. There it is. Those are the settings for the MACD. I should actually write that text down here in the lower window. That's the settings for the MACD, for the divergence. That's the settings that we want to have for the Jerome Plus trade. These settings are not exclusive to the range trading in the Tucson phase. They will pop up again in the counter-trending phase. In fact, I'm looking at a counter-trend phase on the far right, and I have to keep myself from mentioning anything about it. So here we go. Folks, I'm going to say it again. In all of the new Arizona rules, without question, this is my absolute favorite trade of all. Inside of the Android and iPhone apps for the Arizona rules as part of this series, this trade will be highlighted in a section all by itself because it's so important to me, and I really mean that. In the midst of a downward trend, we see the candles falling from left to right. You can see that on your chart right now. The blue 170 period exponential moving average is below the 800. That's a downward trend in a phoenix phase. But just like all trends come to an end, this one does. The candles strike the 800 period simple moving average and rise above it. In fact, not only does that happen, but the trend changes. The 170 jumps above the 800. And Jerome stops by for a visit. He stops by for a visit with his friend Plus, and we create the Jerome Plus trade. Here are the rules. I'm going to speak them out loud, and you can write them down as you follow along, but we'll look at approximately 7 to 10 examples in the next 15 minutes. First step, we have a downward trend. Second step, we have the candles strike the 800 period simple moving average. The trend may or may not end and switch into the opposite direction. Doesn't matter. The Jerome Plus trade envisions a time when we still trade this even though the trend has changed, and that's perfectly fine. We then identify as step 3 divergence, going in the direction of the previous trend that we were just in. In this case, in the pink shaded area on my chart that I've identified right here, we see the candles making higher highs on price and lower highs on the MACD. If you plotted the regular MACD on your chart, you could see this divergence very clearly. The candles would be rising higher and the MACD would be falling. That's divergence. That means that it's an early warning sign that that previous trend lower is coming back for a resurgent move. We've changed the MACD settings to 30, 65, and 23 in order to prevent ourselves from getting too many divergences. We hardly get any with the settings like this. We sell this currency pair or financial instrument when the candles change from blue to red, and we place a stop loss well above the recent high that we were at, and we put a profit target either at the 800 period simple moving average or the previous low. Instead of spending a lot of time looking at this example 12 more times, let's just simply look at another example of it and maybe get in a little bit closer. Get a little closer. That was my singing for the day. In this example, we have a downward trend on the Australian dollar, US dollar. We rise up to hit the 800 period simple moving average. We have no change of trend. We get divergence. Higher highs on price, lower highs on the MACD. A change of color in the candles, and we get a sell trade. Stop loss above the highs, and a profit target at the recent lows down here. Once again, it's a spectacular trade. It's the original Jerome trade plus divergence. Here we go again. We're in the midst of a downward trend. We strike the 800 period simple moving average, and we create divergence. Higher highs on price, lower highs on the MACD, a change of color, resulting in a move downward. End of discussion on that one. In this example, we rise up and strike the 800 period simple moving average right in this area. Let me draw this even more clearly. We go divergent with higher highs on price, lower highs on the MACD, a change of color, and a move down. Do we trade this one to the left? The answer is no. We don't trade this one to the left because we have not yet struck the 800 period simple moving average when this divergence occurs. You could trade it and you would not stop out. It wouldn't matter either way, but just for the record, it's the later divergence in that example that we would take. Here's an example going in the opposite direction. It's a little bit difficult to see, but I'm going to try my best to help you see it clearly. In this example here, we are in an upward trend. We drop and fall to the 800 period simple moving average, and the candles make lower lows on price, higher lows on the MACD, a change of color, and a quick jump upward. Do we get to a previous high? Yes, we most likely get to a previous high. We most likely reach a recent area that was a previous high on the currency pair. Before I answer any questions, I'm going to go back in time and I'm going to look at more examples. Here's another example. The chart's kind of small, so I'm going to see if I can zoom in without causing too many problems. Hallelujah, I was able to do that. And here's the trade. We have the currency pair in a rising trend, the 170 above the 800, but the candles fall and hit the 800, thus creating the Tucson phase or ranging phase of the Arizona rules. The candles are falling, but the MACD is rising, and that's positive bullish divergence. And it's a Jerome plus trade. When the candles change color, we buy, and we get a giant move upward. Now, I'm not going to answer questions even yet. I want to switch currency pairs to a random currency pair and then go back in time on that currency pair and take a look at it. So I've switched to the Euro Swedish kroner, and I'm going to switch to the 1 hour chart, and I'm going to close my eyes and scroll backward a bit, and I'm going to see if I can find a Jerome trade on a currency pair that I haven't yet looked at. I've never looked at the Jerome trade on this currency pair until right now. Euro Swedish kroner 1 hour chart. Does it work across time frames, currency pairs, or financial instruments? The answer is yes. In the midst of an upward trend, or after an upward trend, we fall and hit the 800 period simple moving average. We get a regular Jerome trade right here. If you're waiting for something that takes a little bit more confirmation, you'll wait for the divergence that occurs right here. Lower lows on price, higher lows on the MACD, and then a change of color and a move upward. This is a great example. You might miss it if you blink. In the midst of a downward trend, we rise up and hit the 800 period simple moving average. At the very top here, we have a tiny view of bearish divergence at the top here. Higher highs on candles, lower highs on the MACD, and a change of color, thus leading to a drop in this financial instrument. I can go back and back and back and do this. I could do this all day long, like Lionel Richie or whatever they say. In the midst of a downward trend, we rise up and hit the 800 period simple moving average, Euro Swedish kroner. We then create divergence. Higher highs on these candles, lower highs on the MACD, and a drop subsequently. Those are all Jerome plus trades. Let's just look at one more financial instrument. I'm going to go nuts now. New Zealand dollar, Hong Kong dollar. I'm not sure if I've ever looked at this currency pair or not. I'll re-put the template up here. Just take me a moment to do so. And then, Sean, we can get to questions that have come in from traders all over the place. We'll just look at the most recent examples that we can find. All right, here we go. In the midst of the downward trend, the 170 is below the 800. We rise up and we hit the 800 period simple moving average. Now, we don't know where the bottom of the range is, but we do know that's the top of the range right now. Oh, please do not. Thank you, charts. We go divergent. Higher highs on price, lower highs on the MACD, and then we drop. What seems like just moments later, we rise up and hit the 800 period simple moving average again, and we get higher highs on price and lower highs on the MACD, and we get divergence and we get a turn. We do it again and we stop out in this example, and then we don't get divergence here, and we don't get divergence here, and we don't get divergence here. So these are not trades. I've never looked at the New Zealand dollar, Hong Kong dollar, so I don't know if this is the dumbest thing we've ever done in our lives. But look at this. We fall and we hit the 800 period simple moving average at the conclusion of this upward trend. We get divergence here, but we don't get a change of color. Then we get divergence here, and we do get a change of color, thus leading to a rise back up to the 800 and or a previous high or low. Then what we get is we get a shift. We hit the 800 here, and we get divergence. This answers Vincent's question. When the 800 is on top of the 170 and we can't tell what the trend is, what do? Well, we just trade either divergence in either way. Vincent, you can trade short here on this divergence. That would be perfectly fine. Then we get another short trade here, and then we get another short trade here. These are all Jerome plus trades. This is the highest probability trade setup in the Arizona rules so far. It's super reliable, super enjoyable to trade, and will allow you to show off at all the best cocktail parties. Here we go. New Zealand dollar, Hong Kong dollar trending upward. We fall and hit the 800. We go divergent. Lower lows on price, higher lows on the MACD. We change colors and jump back up. So I have now looked at probably 10 or 15 examples of the Jerome trade here, Shawnee P. And I want to look at one last.
I keep looking over my shoulder for my grandma when I hear that.
Shawnee P. Shawnee P. When
Sharpie.
when I was a girl. When I was a girl. Really? Really? You just when
That's
you
a
were
whole
a girl?
different conversation, Rob.
When you were a girl, Grandma? Okay, here we go. So the euro-dollar 1-minute chart is in a downward trend, 170 below the 800. Rises up and it strikes the 800 period simple moving average. It goes divergent, higher highs on price, lower highs on MACD, and does a quick drop. It drops probably to a previous low. This is the 1-minute chart, keep in mind. So it's not a substantial trade. It's probably only worth, I'd say, 10 pips. But that's what you get when you're trading those really short-term charts. Followed by another hit of the 800 period simple moving average and another Jerome trade. That's a standard Jerome trade right up here. Sean, what kind of questions come through?
All right. Any difference as to the solid line versus the dotted line in red and green on the MACD divergence plotted on the chart?
For the Jerome trade, the only line that we want is the solid line. The solid line designates regular divergence, not hidden divergence. The dashed lines are hidden divergence. Those we use inside of the trend trades that we take. We don't really ever use them for the Jerome trade.
What about settings on the MACD? Are we using the 2.5 settings just for the Jerome trade, or are they applicable anywhere else in Phoenix phase or anything else?
We only use the 30, 65, 23 for the Jerome trade right now, but we will use them for counter trend trading in the Yuma phase coming up to a theater near you. The euro is really getting cracked open like a nut.
It's beautiful.
It is beautiful.
Let's see. When you are describing trend, do you mean to check daily trend and 5-minute market flow, or is it simply if 170 is below 800, it is a sell even if MAs are horizontal rather than sloping?
The slope of the moving averages don't matter. The question came in earlier that asked that. We don't care about the slope of the 170 at all. We don't care about the slope of the 800 and the 170 on these charts at all. We do not care. Slope is a very, very fickle thing. You could see the slope change right before the non-farm payroll report and lead to a giant blast-off move. And you can see a very, very aggressive slope in the past. And all that does is tell you about the recent past, and it doesn't tell us enough. So the slope of the moving averages don't matter. And the only chart we check for the detection of a trend is the chart we're trading from. We do not look to a higher time frame chart to check the trend. We don't do it.
Let's see. I think that pretty much covers it.
All right, that concludes
Except
the
for we had a
Jerome
question that
Plus
said, Rob, are
trade.
you going to be
Arizona Rules of Trading Webinar 4, Part 3 or 4. This is the Benson Highway trade. It's another method of trading in the range with the Arizona Rules. And to present this methodology, here's the Bishop Sean Campbell.
All right. This is a little bit different definition of a range and use of a range than the Jerome trade that we just discussed. When I was looking at these, when I was playing with the moving averages and working on this system, I noticed that there were a lot of times where the 170 crossed and then basically just developed a new trend right away, and that's why we developed the Phoenix phase. I loved that, but there are times where the 170 will kind of hang around the 800 for a little while and kind of condense and spend some time there. So and I would try and range trade it, or I'm sorry, try and trend trade it in the Phoenix phase, and it would stop out quite a bit. So I had two choices. I could either say, okay, I need to create a range system and figure out a way to trade smaller profit targets, quick trades, and figure out a way to trade when it's in there, or I just need to stop trading altogether and wait for price to choose a direction. So basically how I started out was saying, okay, I want a way to define how this looks. So what I did was I incorporated an envelope, and I made it an 800 period simple close envelope at 0.15 deviation. And this is why we call it the Benson Highway, because it looks like a road, right? So anytime I'm on the road with the 170 and the 800, I'm looking to trade this as a sort of a range trade, something that the price has not picked a direction or a trend, and I want to trade it. The difference between what we talk about here and what we just talked about with the Jerome is I will trade it in both directions. I'm not necessarily concerned with which way it's going because I don't know at this point. So from here, to set up my chart, two more indicators I added. I had MACD with the histogram. The biggest key to the MACD is I put in these levels. I put in 0.0005 at the top and negative 0.0005 at the bottom. And what it does is it creates these two bands right here. And what I'm trying to do is say, okay, price is trading within a band, and I want to be able to identify that in as many ways as I possibly can. And I'll explain how I use that in just a second. From here, the last thing that I add is the commodity channel index. Parameters, I set it to 20. I played around with a lot of different numbers. This is the one that I like the best. And then I have levels on this indicator as well, positive 230 and negative 230. And again, it visualizes like this and gives me bands. So what I'm trying to do, the whole idea behind this for me was to treat this highway as a bit of a rubber band. I want price to kind of exceed or kind of stretch out in a direction, I should say. And then I'm assuming that since it's in a range, it's going to bounce back in the opposite direction. So let me walk you through how I set this up. As we come through a trend, 170 trading outside of this band, as we move closer, I start thinking about turning this system on. And once the 170 crosses inside, then I'm Benson Highway ready to go. From here, what I'm looking for, first off, is I go down to the CCI, and I'm looking for any time that CCI pops out of its band that I created for it. And again, this is just my settings. This is just what I prefer to trade on it. Top side or bottom side. And I'm looking for both as we go through here. So the problem that I found with this as I did this, though, is that CCI wasn't enough. There are a lot of false signals that didn't indicate very much. It was a great early indicator for me, but it wasn't enough to make profitable trades on a consistent basis. So I added the MACD, and what I wanted to do with the MACD was this is sort of defined as in the range as well for me. Price is trading within a range. And when the MACD pops out of those, I consider it to be that rubber band effect, where it's overextended a little bit in a certain direction, and I want it to go back in that direction. So in this instance, let me walk you through a couple of trades. We've got CCI popped out. Before the color change, during this, when the CCI popped out, there was no MACD overextension before the color change. So that's a no trade for me. Again, we move along here. We've got a CCI that expands out. There's no MACD continuation or confirmation that says I need to do anything at this point. This one right here, again, there's just a little poke out, but no MACD confirmation. Right here, we get CCI moving out, but I get the MACD confirmation. So now that this has happened, I'm looking to trade this. I'm looking for a color change in the opposite direction to trade this. All of this happens within the move. The CCI indicates really early on any of these, and MACD confirms it, and then I get a color change. And from here, I am looking to trade this thing in the opposite direction. I love it when it pops outside the bands and makes these trades right here. These are great. So what I do is I trade the color change after I get all these confirmations, put a stop above the recent highs, in this case, and when I tested it, I ran just a straight profit target and stopped. But I like the 170 a lot as a profit target, or even the middle of the band, the 800 is can be a great profit target on these. Moving along, next examples that we have a CCI touch here, but no MACD confirmation. We have a CCI move out down here. We get a good MACD confirmation, and then we get a trade in the opposite direction. We get a color change. So again, that's a qualifying trade for me. And it's a progression from top to bottom, left to right. I get a CCI, I get MACD, and then I'm looking at the chart saying, okay, let's get a color change. And that's the basic Benson highway trade right there.
That's awesome. Let's see what questions come in. I like that music. I don't know how the MACD confirms the entry point, says Daniel.
It's more just when MACD is traded, and this is a theory that I've seen. I haven't practiced it a ton, but there's an idea that when MACD is in between these two levels, that it's considered a range trade.
Mm-hmm.
So basically what I'm saying is that once it trades outside that range, I have confirmation that from my moving averages that we are in a range trade, so I'm expecting the price to move back in the direction of the mean.
Yeah, you're looking for an exhaustion move that leads to a spring back.
Yeah, that's all it is. It's just a rubber band effect, right?
Yep, exactly. It's fantastic. What's the settings on the envelope?
It's an 800 period, simple close, and then I run a 0.15% deviation on it. And from what I've seen so far, it's good on a 15-minute time frame, a 1 minute. I haven't tested it out to the hour. I'm assuming it may have to be a little bit wider, but
yeah, we'll have to adjust it for the 1 hour.
Anything lower than an hour.
Yeah, but for the 5 minute to start with, this is a great range trading methodology on those shorter term time frames in particular. Scott, does anything occur to you as you watch this?
No, the MACD part is interesting. That's what I'm most interested in. We've looked a lot at CCI, but the fact that you need some extremity in the MACD, I like that twist. I think that definitely gives it a little more potency and go in the opposite direction.
Yep. I want to get T-shirts made that just say
It helped a ton. It filtered out a ton, and the reason that I use this as a range trade is because it gets absolutely annihilated in a trend.
Yes.
You get all kinds of signals, and they just there's no way you should ever think about trading this in a trend.
Right. Yeah, the envelope really keeps you out of that.
Example. Yeah, and then once the for me once this 170 moves out of the envelope, I turn right back to Phoenix. I'm just right back into the trend trading.
Yeah, that's important to mention as well. Once the price moves outside of that yellow envelope, which looks like a highway, that's why we call it the Benson Highway. The Benson Highway runs through Tucson, Arizona. That's the name. It looks like a highway. Benson Highway is in Tucson. Tucson's the range phase. Get it? Okay, that's all we need to tell you. Once we're off the highway, Sean, we're in the desert, just rolling along. And eventually we'll come back on the highway. But once we leave the highway, we don't want anything to do with it.
Yeah, and there are a lot of times where, and this is something I appreciate about this as well, is there are a lot of times where the 170 just moves straight through, and you create a new trend and you just go. And I really don't get, you may get one false signal, but most of the time I get no false signals as these things move straight through.
It's just incredible. It's really great stuff. It's always enjoyable to listen to you describe a system. That was the Bishop Sean Campbell teaching the Benson Highway trade in the Tucson phase of the Arizona Rules.
The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. No, not off the top of my head.